Joining me now with more is Jeff Currie. He is the global head of commodities research at Goldman Sachs. Jeff, great to have you here today.
Great.
Man,
thanks for having me.
Where do you think the price of oil goes now?
Well, this in no way derails our view for higher oil prices. First, this is not a lot of oil. The U.S. releases 50 million barrels. That's a half a day of consumption. The deficits are running anywhere week by week, 2 to 4 million barrels a day. They're persistent, not transitory, one-off event. By the way, a backwardated forward curve is very bullish, not bearish. It doesn't mean prices are going to go down. A backwardated forward curve tells you you're out of the stuff today. You don't care about tomorrow. The example I like to give is oxygen. You'll pay a big premium to have it today because you don't need it tomorrow because you're not going to live to tomorrow. So these backwardated curves are not to be viewed as being bearish. They're very bullish. It tells you the market is in a significant deficit. In the 50, add in another 10 or 20 that the rest of the world's going to do, 70 million barrels at most, does not solve the persistent long-term problem that's facing the market. And then I think the third point to keep in mind is the OPEC reaction function. Their goal is to draw down inventories, to normalize them, and they're likely to adjust their production hike to this action. So the ultimate impact is going to be very minuscule at best. But I think more importantly, what this does is it reduces prices. That actually the price signal is needed to solve this long-term problem, which is an underinvestment problem. We like to call it the revenge of the old economy. Bad returns in the sector saw capital redirected to the new economy. And the only thing that's going to solve that is higher prices.
So he basically says they've gotten the oil price down from around 85 to 78 because of this coordinated talk. And I think plenty of people in the market would say, okay, maybe that's true. But do you think basically it could spike from here? And
you're back to 81 or 82.
Yeah.
And you haven't solved the long-term deficits that are facing these markets. And they're just going to get worse as we go forward. The bottom line, if you want to solve this problem, get U.S. rig counts up to 500 or even higher. That's going to solve this problem. Or adding a few barrels out of storage is not.
As another analyst last week suggested, the only way this could be truly solved and structurally lower prices would be to cut a deal with the Saudis, basically, where they would agree to bring more supply onto the market. I know that's more of a geopolitical issue than anything, but what would you think about that?
You got to invest. Saudi is investing. UAE has invested a lot. There are only 2 countries in the world today that can produce more than what they were producing in January 2020, and that's UAE and Saudi because of the investment. But I think the key point here is not just one group that needs to invest, being Saudi Arabia. It needs to be the industry. And the only thing, and what we know is we're at $85 a barrel, and you didn't see a huge surge in CapEx, nor did you see a big run up in drilling or anything of that nature. You're not seeing it. Not only is it a problem in oil, gas, coal, it's a problem across the commodity spectrum. That's why we're arguing we're in the first innings of a commodity supercycle.